You see a little pre-FOMC volatility here. Decision, so I understand to do out in 15 minutes, but perhaps a little pre-positioning, little speculative positioning, possibly some profit taking. Well, let's start with this. I am Curt Wehrley from FX Bootcamp, FX strategist and trader coach at that Forex education firm. Been a trader coach at Bootcamp for more than 5 years. A currency trader before and since I started coaching at Bootcamp. Been doing several webinars here at FX Street, a number of them last year, and more weekly webinars more recently here. Was invited by the fine folks at FX Street to conduct this special event to cover the FOMC decision. Thank you very, very much to FX Street for inviting me to this and for making sponsoring all these events, for making these events possible. Really appreciate what they do, and not just for my events, but for all events. They do a great job they're very good at what they do. So, again, thanks to FX Street. Let me first remind you the purpose of this event is education. I'm not going to provide specific trade alerts or recommendations. We will do some technical analysis, certainly do some assessment or analysis of what the so-called FOMC has to say or perhaps not say. We've got actually, let me start with this. One basic question some of you might be pondering is why? What's so important about this? What's the big deal about this? Well, the U.S. economy is, at least last I checked, is still the biggest economy in the world. And of course, the many economies, including the U.S. economy, have struggled of late ever since the onset of the global financial crisis beginning with this the U.S. subprime mortgage crisis back in late 2007. So ever since then, a number of major central banks, including the U.S. Federal Reserve, have been pursuing some stimulative policies, lowering interest rates and such, and actually the end such is the most important part. The Federal Reserve lowered its benchmark interest rate down to near zero levels back in late 2008 after the Lehman Brothers bankruptcy, and that's been the classic policy tool for the Fed and other central banks, lowering rates. Well, when the Fed took its benchmark rate down to near zero, it had to do something more, it had to do something else. So what the Fed has been doing ever since then, to varying degrees in various ways, is a program or approach called that many refer to as quantitative easing. Quantitative easing, simple description, a central bank buying government bonds to bring down long-term rates to help stimulate the economy. So the Fed has announced and has pursued so-called QE1, announced and implemented in more than one phase back in late 2008, early 2009. The so-called QE2 program, hinted at by Federal Reserve Chairman Ben Bernanke in his speech in Jackson Hole, Wyoming in late August of 2010. That program formally announced on November 3rd of 2010. And then another form of easing program been dubbed Operation Twist. That was announced in, I believe, September 21st of last year. And Operation Twist actually ongoing, although it's only going on to prevent it from stopping, and I won't get into details here. My time is limited. I got to be careful with time because the Fed announcement may come out sooner than expected. The scheduled release time of the FOMC statement is 12:30 New York time. It may come out sooner. Sometimes they're a few minutes early, sometimes they're a few minutes late. So a little background there. The economy is still struggling, and there's some speculation, there's some debate right now as to what could be done to further stimulate the economy. You've seen it in terms of several speeches by the likes of Federal Reserve Chairman Ben Bernanke. You've seen it in comments by other central bankers, not just at the Fed, but at other major central banks. What can they do to further stimulate the economy? Well, the Fed, in their defense, I think would like to see more done by U.S. Congress, but as you can suspect, with U.S. elections coming up in early November, Congress likely to do little to nothing. So the Fed right now, right or wrong, good or bad, the only game in town. And many believe, again, right or wrong, that the Fed's poised to do something. There was a CNBC survey. CNBC is a financial news network based in the U.S. CNBC survey recently conducted, like late last week, earlier this week. The results of that survey announced earlier this week. Some 3 of every 4 money managers surveyed. They conducted a survey of money managers, economists, and such, and 3 of every 4 people surveyed believe the Fed's going to announce something today, just in the next few minutes, whether it's QE, perhaps another easing initiative. They might provide guidance, which I'll explain later, especially if we get that guidance. Guidance relates to how long they commit to keep the Fed funds rate low for a period beyond, say, maybe 2014. There's talk about other policy moves, such as lowering the interest rate on excess reserves. We'll talk about those moves if and when the Fed announces they're going to do something. So before I do anything else, I want to make sure I give you a look at some recent moves on the Euro-USD currency pair in response to this event. This event can definitely move the euro in significant ways. So if you're in a euro trade, or at least pondering a euro trade, I want you to be aware of what kind of things that could happen. And yes, it's the dollar that's most likely to move the most. Sometimes we see moves on the yen crosses. I'll probably focus more on the dollar during this event, especially the Euro-USD, as it's the most liquid, the most heavily traded currency pair on the planet. Which one do I want to look at first? I'm going to look at the response to the so-called QE2 program announced back in November 2010. You should now see a 1-minute chart. This is a 1-minute chart showing the price action on the Euro-USD currency pair in response to the so-called QE2. Harley, I'll explain that in a minute. It's a good question. There's some questions about, why the change in time. It's a new policy by the Fed. Every 3 months, I'll explain it now. Every 3 months, the Fed, instead of the typical 2:15 p.m. announcement, what the Fed will do is release the FOMC statement at 12:30 p.m. New York time, a little less than 10 minutes from now. And then in 90 minutes after that, they will they will announce their latest projections for both economic growth and inflation in the U.S. And then 15 minutes after that, at 2:15 p.m. New York time, the normal release time for an FOMC statement, that's when Federal Reserve Chairman Ben Bernanke will begin his press conference. So Bernanke conducting a press conference today, similar to what ECB President Draghi does virtually every month. Now, the Fed doesn't do this after every single meeting, but about every third meeting, or about every 3 months, the Fed is now doing this new thing of announcing the policy decision first, economic projections after that, press conference after that. I'm covering solely the decision itself. So you see a rise on the Euro-USD, a quick rise in the first minute. The euro jumps from about 1.4020 up to about 1.4185. You can do the math there. That's a big jump on the Euro-USD, but a lot of pips there. Big jump, and then look what happened over the subsequent minutes. The Euro-USD jumped high very quickly, and gave up all those gains over what was it 30 minutes there? It's actually more like 15 minutes. So that kind of thing is very possible. An initial jump, hey, the dollar weakens. QE2 announcements was announced back then in November 2010. An initial reaction of dollar weakness in response to more easing by the Fed, a logical reaction, but the fact that the euro totally flipped, the fact that the dollar totally flipped, tells you something about what was priced in at that time. The market largely expected QE2. Strong hints from Bernanke at Jackson Hole speech in late August were the clues there. The market, the euro had been rising for weeks in advance of that, and the euro initially jumps and then flips. So here, word of caution here, be very careful. That sort of scenario quite possible today. Show you a couple of other moves. Let's look at the most recent move, the response that is to the last FOMC statement. Oh, that's not it. I want to go to where's my August 1st move? Here it is. In this case, it appeared to be a drop in response to perhaps disappointment that the Fed did announce an easing program. I see this as a real possibility today. It seems the market is to some degree priced in, as I mentioned earlier, some sort of policy easing move by the Fed. Again, some great numbers. 3 of every 4 money managers surveyed by CNBC believe it's some sort of additional easing is kind of baked into the cake, that it's a done deal. So you might get a scenario where the dollar has been under pressure leading up to this decision, and if in fact the Fed announces QE3 or something like it, the dollar could actually rally. So keep that in mind. That drop, by the way, on August 1st, following the FOMC statement, that was a drop of somewhat 80 pips over the course of about 30 minutes. That's about all I have the time for there. In the time I have left, I'd like to see if I can post one thing, and maybe a couple things here. See what time I have left. I'm going to post a quote from the minutes of the most recent FOMC meeting conducted July 31st and August 1st. And I may get cut off short because of if the FOMC delivers their decision sooner than 12:30 p.m. New York time, a real possibility. By the way, we're at a trend line on the euro. Let me post it again. There's a statement the statement from the FOMC meeting minutes released in August that have led many to believe that some form of additional easing policy from the Fed is inevitable. That second sentence especially, and I'm not going to read a sentence for you. You can read it read it yourselves. If I had to interpret the statement literally, the word that strikes me is sustainable. Sustainable. What's the Fed's definition of substantial and especially sustainable strengthening in the pace of economic recovery? I don't know. I think it could be 3, 4, 5 months of NFP numbers. Anyone seen NFP lately? Anyone noticed the NFP numbers lately? Let me cue up those figures real quick. NFP numbers, although showed some promise, the July number released in early August showed some promise. Last month's number, not so good. Yeah, it sucks, yes, but I guess really sucks would be negative. We haven't been negative, but then again, we haven't seen anything that encouraging either. So my definition, and this is I'm actually building the case. I'm not saying I fully endorse this, but those who expect the dollar to strengthen on the back of disappointment that the Fed does nothing, the one reason why the Fed might do nothing, the Fed might be waiting for some evidence of sustainable economic recovery. Sustainable could mean, again, 3, 4 months of economic data before they make their decision. So that word sustainable strikes me. But having said that, again, there have been some strong quotes from prior statements. And also the speeches from the likes of Bernanke that QE could be forthcoming. Bernanke, at his Jackson Hole speech back in late August, did spend a bit of time defending prior actions. In fact, he cites a study, which I'm going to quote right now. Bernanke, at his Jackson Hole speech, said that models used by the Fed suggest that the prior, he refers to LSAPs. Those are large-scale asset purchase programs, QE1, QE2. Bernanke doesn't like QE1, QE2. He doesn't like the quantitative easing phrase. Anyway, Bernanke made the case at his Jackson Hole speech, and you may disagree with it, but Bernanke was trying to build a case that there's been some that the prior quantitative easing programs have helped. Perhaps in that speech he was laying the groundwork for another easing program by the Fed to announce either this meeting or subsequent meetings. Another reason why the Fed might not announce at this meeting proximity to the election. Want to avoid any political conflict there. Don't want to avoid any appearance that the Fed is looking to help the incumbent. That would be Obama in the White House. And that's about all the time I got. We're a minute away from the scheduled release of the FOMC statement. Here's what I'm going to do. I'm going to wait for the announcement itself. I'm going to look for the statement that's posted on the Fed's website. I should get some updates from Trade the News, the news service I'm using right now that provides reports decisions such as this. And we'll make some sense of not only the Fed statement itself, but also the price action. Key levels on the Euro USD. The 28.15 zone put a floor into the Euro yesterday following the release of the German Constitutional Court's decision on the ESM. And you can see the basis, hopefully, for the trend line here. Ever since that rise in the Euro yesterday, the Euro has been trapped in a range between about 28.80 and 29.30-ish area. Again, I will focus on the Euro most of all. Okay, Andy, I won't disagree with you. Andy, I only showed NFP as one number. I find that the employment number is more accurate than unemployment, even though the Fed refers to unemployment, because unemployment, it's so skewed by how you measure the participation in the labor market. You know, who's in, who's out. You're right. The Fed does refer to unemployment levels more than the actual employment level per se. Yeah, but regardless of what I think, regardless of what anybody else thinks, the Fed continues to cite Fed numbers continue to cite the lack of recovery in the jobs market as a seemingly as a reason here. Okay, I don't have an announcement yet. It should be out any time. Nothing from Trade the News at the moment. Perhaps some overeager dealers or traders. I'm going to the Fed's website looking for an update. Trade the News should be right on it the momentum of the decisions. It's not unusual, by the way, for a delay in the decision. I don't know if they're going to be dotting the I's and crossing T's here, if that's the reason for the delay, but it happens. It's not unusual. Okay. There is some sort of a quantitative easing announced. I'm hearing $40 billion in agency mortgage-backed securities procured per month by the Fed. Perhaps more of an open-ended program whereby they don't. Look at the move in gold. Actually, I should have specified earlier. Be very careful here. Unusual volatility is a possibility, as I showed in the reaction to the QE2 announcement. We're back to today's and yesterday's highs on the euro around 29.30. Very reasonable to await for volatility to settle down to see if there's any trade to be had at all. I'm still sorting out the Fed announcement here. Looks like they extended their low rate pledge. I mentioned earlier guidance. So they provided extended guidance on keeping the Fed funds rate low for longer than they previously committed to. They're going to buy some $40 billion in agency mortgage-backed securities per month starting Friday. And here's the initial reaction: dollar strength, fall through, dollar weakness. 1.30 area coming up on the euro, some 40 pips north of here. That could be a significant near-term ceiling for the euro. And the move on gold, very telling. Gold tends to rise on the back of more QE by the Fed. Heck of a move on the Aussie. I'm going to 1 minute chart for the euro. For you new scalpers, this is aggressive, but a potential buying opportunity around 29.30, perhaps as low as 29.15. The high during today's New York morning session. Actually, I'm sorry, it's the pre-news high, not the high during the New York morning session. Again, be very careful here, folks. Remember the reaction from the QE2 announcement that I showed you from November of 2010? Euro initially rose and completely flipped. There you go, back to 129. Chop shop has been the order of the day here, or the order of the past few minutes. And I should describe the way to play that. If you were conservative at all, you would have waited for some hesitation there at 29.30, perhaps for even a minute or two. Otherwise, you took a more aggressive scalp long at 29.30, and potentially even got knocked out once it dipped below 29.15, which I mentioned earlier. Again, very difficult price action here. For first down, then up, then a nearly as big of a move back down. Yeah, it really has been some stop clearing here. Oh, thanks, Bot, for the update about the Operation Twist. Mon says Operation Twist to continue for through the end of the year. Really a tough, what can I say? A tough trade here. A tough trade. Well, one way to do this is to, given the bounces we have, I go back to a 5-minute chart. You can just about make the case for putting them to a couple of lines in your charts. 2960. Who knows? 2960 may come into play later, perhaps during the next Asian or London session. Same for 2855, 2860. You know, that could be really what you glean from this post-news reaction. The fact we may have some significant support and resistance levels identified for use in later trades. If you ignore the wicks on the previous 5-minute candle, I mean, look where we're at. We're back to where we were for much of the today's New York morning session. In fact, we're almost back to where we were before the news came out. So if there were ever a time and a reason just to sit on your hands and stand pat and wait for the market to sort this out, it's now. Mean upper wick on the Aussie as well. Well, the sell-off following, which was a QE2 that we saw, I mean, it hasn't manifested yet. For now, it's just been choppy. Let me check those again. Actually, well, there's the QE2 reaction. 1-minute chart again on the Euro-USD in response to the QE2 announcement in early November of 2010. Not quite as wiki, perhaps, but again, thus far a similar move. To ignore the initial dip down, we got a sharp rise up and a drop back down. So we got that today, and we got something like that in response to QE2 announced in November of 2010. Yeah. Sorry, Solomon, if I wasn't specific about that. There has been an announcement of, I don't know if it's going to be called QE3, but yes, it perhaps could be called QE3. I said earlier, $40 billion worth of mortgage-backed securities per month the Fed is committed to buying. So actually, I haven't seen anything with regards to if that's open-ended or what. I'm going to pull up the FOMC statement. I see no cap on that. That is an open-ended commitment. It appears to me. Don't quote me on that because I haven't read the entire statement. But it looks like an open-ended. Cam says looks like QE forever. Yeah, this was cited by some sources as a possibility that instead of defining a limit to the purchases, making it more open-ended. What I'm not seeing in the statement yet is conditionality. I am not seeing conditionality by the Fed, which could eventually have affected price action on a currency like the dollar. That is, by conditionality, what I mean is that a central bank like the Fed, for example, may commit to doing something, may commit to buying something, in this case, mortgage-backed securities, until some condition occurs. Like, again, what that condition remains to be seen. Perhaps it's, I don't know. It could be things like some one form of conditionality that has been proposed. It doesn't apply here, but one form of conditionality that's been suggested has been like GDP. The Fed would do easing until the nominal GDP level, or maybe the real GDP level, attained a certain level. Let's take a peek at the yen crosses. somewhat similar move in the yen crosses. First a spike down, then a spike up. So again, first brief yen strength and now yen weakness. Perhaps the yen crosses, if you're looking for a scalp trade, not that everyone should, but if you're looking for a scalp trade, these might be the safer bet, perhaps less volatile. At first glance, of course, it's already manifested, but I was going to say one pair that looked interesting was a euro yen long around 100. The 100 area put a cap on the euro yen before the news came out. But that's that entry, if you took, it's already come and gone. New post-news high for the euro yen about to be made now. Yeah, true, Bill. The question is, has it been priced in? Hard to tell from the reaction thus far. Now, Andy, I don't know that the media is going to agree with you on that. Andy says basically no QE3. Andy, $40 billion per month of mortgage-backed securities. That's quantitative easing, dude. That's quantitative easing. I don't know if it's going to be dubbed QE3 or given a different name, like the Operation Twist activity. But dude, that's QE, man. QE1 involved acquisition by the Fed of mortgage-backed securities. I mean, $40 billion per. Do the math on that. $40 billion per month. What if they do that for? I mean, I don't see again any conditionality on that. I don't see any limit to that. So what if they do that for 8 months, 10 months? There's $40 billion of mortgage-backed securities acquired by the Fed. Yeah, hardly for now. If you're looking for a basic signal here, is this dollar positive, dollar negative? Yeah, the fact that the Fed is still doing more QE, it's dollar negative. It is dollar negative. But again, consider that the market has had plenty of time, plenty of clues to price this in. The big question right now is it as Bill said, is it something that's going to continue to weaken the dollar, or is it my opinion, my personal opinion, based on observing price action in response to not just U.S. data and in response to things like the Fed speeches, but also in response to headlines and events out of Europe. I'm still inclined to believe that the market is, over the medium term at least, going to be more steered by, more influenced by what happens in Europe. By the way, I mentioned the mortgage-backed securities. Can anyone tell me what sector of the U.S. economy are they focusing on? What sector of the U.S. economy is this easing program focused on? Again, mortgage-backed securities is what the Fed is acquiring. Housing, yeah. The Fed has now, for actually not just for months, but for years, has been defining the U.S. housing sector as depressed. Yeah, Hardy mentions that. Andy, I'm not here to debate what you call it or what you shouldn't call it. Well, Andy, maybe educate me, Andy. Educate me. What do you think the market was expecting? There's a survey done by, actually the same survey I said earlier, but I didn't cite this point. A survey conducted by the CNBC asked some 58 money managers what they expected, QE3 or not, and if so, what form would it take. The average response, the average response in terms of amount of quantitative easing, $500 billion $500 million. Now, I don't think what they nailed down in that survey, which is, exactly what, how it breaks down as Treasury securities versus mortgage-backed securities. Or will they be sterilized? Referring to Kevin's comment there. I haven't even read the entire statement, so I need to read the statement here. Oh, that's what Talking Forex just said. Yeah, I see no reference to sterilization in their statement, but maybe reading between the lines. I see their policy of reinvestment is continued. Folks, what can I say on the Euro-USD 5-minute chart? The 2880 area was important. Was important yesterday. Was important today. The 2930 area put a lid on the euro earlier today. It actually even yesterday as well. And we're sort of straddling 1.29 right now. I mean, I don't know if you could be more neutral on the euro right now. So it's just nothing to do. Nothing to do. And if the euro is mixed, if the euro's reaction is mixed, I can't say I'm overly thrilled in doing anything with any other major currency pair. Well, we mentioned earlier the potential scalp long. Again, belatedly admit, but mentioned earlier the potential euro scalp long, which made some sense anyway on the euro yen. Perhaps some opportunity to materialize on one of the other yen crosses. And that's about it. Well, Andy, I made that point earlier. Andy talks about jobs. Andy, I thought the answer was obvious. I should clarify. Well, so Andy poses a great question. How is mortgage-backed securities buying related to jobs? Anyone have an answer to that? Well, again, I posed the question earlier. What does mortgage-backed securities, what does that support? What sector of the U.S. economy does that support? Yes. And what sector got hit hard? Actually, Jack, that's an interesting answer, and you're right that to some degree it could support the banking sector as well. In terms of jobs, what sector got hit very hard following in the wake of the financial crisis? Yeah, exactly. Now, is it going to be effective? Gosh, who knows? I'll let the economists and the historians figure that out. Now, is it the best way to boost jobs? I mean, that's doubtful too. I mean, if Andy objects to it, I mean, or anyone else, I see your point. But, I wouldn't go as far as say this will have no effect on jobs. But, the tough thing about assessing these QE programs, and Andy, with all due respect to you, I sense from your comments and sense from similar comments from other participants in other webinars and even from Bootcamp members that I've seen some traders out there that get very preoccupied with at times with what, say, government officials should or shouldn't do, what central banks should or shouldn't do. I used to be that way, and in some conversations, in some contexts, I get that way again. We're all worked up about what the U.S. government should do, or what Draghi should do, or if I were king of the world, what I would do. But you know what? Bottom line, what I focus on is I don't care what Bernanke or anyone else should do. I don't care what Draghi did do. What I care about is what investors and traders are thinking about and what they expect to happen and how they're going to position themselves. So, Andy, don't take that personally. I really appreciate your comments earlier about, if anything, it certainly gives us, and the other comments that everyone else is making, give us good material to talk about here. Oh yeah, Harley, it is. Well, partly it's this is now. Let's qualify this. Now, Kevin mentioned earlier some sterilization of these. I haven't seen any reference to that in the statement, but I admit I haven't read the entire statement with a fine-tooth comb. If, and this is still a big question, if the Fed's mortgage-backed securities purchases are unsterilized, then I mean it is a form of quantitative easing. It's because they're not buying treasury securities, they're still buying a security, which is still effectively printing money to buy new securities. It doesn't have to be treasury securities, but it's again mortgage-backed security acquisitions by the Fed were a part of what was the QE1. And yes, Hardy, this does, from what I'm seeing and hearing, and what I'm reading from the Fed statement thus far, this does increase their balance sheet. Andy, I saw plenty of references to a form of quantitative easing geared towards the housing market. And again, it makes some sense. I've heard if there's two themes I've heard from the Fed for months now. It's more than months. It's been years in terms of the housing market. Two things. More recently, the focus has been on jobs. But even before that, for the longest time, I've got a graphic on this somewhere. A graphic showing how the Fed's language, how the Fed's assessment of the housing market has changed. But the Fed has referred to a housing market as depressed for a long time. And again, the housing market was a source of a number of U.S. jobs, and especially the source of a loss of a lot of U.S. jobs following the onset of the financial crisis. Now, is it? And we can debate all day, and I'm not a big fan of this. I'm not a big fan of putting so much emphasis, putting so much reliance upon the housing market as a source of jobs. But you know what? If you look at history, that's where that's one place that a recovery has begun, in the housing market. And recovery in the housing market can have a ripple effect. Then again, history will tell whether or not it's the right thing to do or most effective thing to do. At least we hope it will. Back to 2880. Perhaps on the euro here, a higher possibility. We're near the daily central pivot point. I'm going to go back to euro charts with indicators. Yeah, Solomon, I see a comment about equity markets. Equity markets have been so stagnant of late. We're back at the daily central pivot point for the euro, and if you ignore the wick from earlier, we are back at a trend line. I mentioned this before the session started, which I don't know if I showed on this chart, but I certainly where's that trend line at? I had a trend line on one of my euro charts, sitting around 2880. Shoot, maybe I deleted it. Might have been that one, but I don't think it was that one. Yeah, I think it was just based on the more recent swing lows. But that one's certainly a possibility. No, actually, the other trend line was, if I recall, something like this. Yeah, that was the basis for the other trend line. Interesting, by the way, at least in my opinion, how the blue trend line, came into play. But again, my point, daily central pivot point, a zone which was important yesterday, could provide some support for the euro here. You think this is just a jumbled mess, if you'd rather see the euro settle down, if you'd rather trade this during the Asia and London session, I do not blame you. Kevin, I see your comment about considerable time. That looks new. Well, they did extend the commitment, I believe, to mid-2015, which I thought it was like end of 2014 before that. I'm checking the prior FOMC statement from August 1st. Yeah, late 2014 was the prior guidance, the prior forward guidance for the Fed funds rate. So they extended the guidance, $40 billion per month in mortgage-backed securities. I'm not seeing any cap to that, any limit to that, or any conditions around that. Oh yeah, I mean all of this is potentially inflationary. But I mean, if you see measures of inflation, now we can get into a debate about how inflation is measured, and it's a rightfully a debate that should be had. But by the official measures of inflation, it's just it's not there. Now the unofficial or the true measure of inflation, that I've seen are going to be a different story. Well, euro back up near the back up above 129. So again, the choppiness continues. No, but GY was not. GY and perhaps I wasn't clear about it. In my opinion, the best approach, the best view was to not trade it. The best approach was to not trade it at all. And there's value in that. There's significant value in recognizing when to trade, when not to trade. And don't get me wrong, events like this, they are some are very tradable. Combination of price action, but plus what's announced or not announced can suggest some very viable trades. Just not today, not today. To me, the best shot we had at a trade period really was along around 29.30. And I should have been clear about that. If there had been some hesitation around 29.30 there, or perhaps some of you took along at 29.30 and maybe with a lower lot size, to minimize your risk and a dip below 29.15 or 129, you're out. But what spooked me about that trade, I discussed this at our New York FX trading room at FX Bootcamp today. I feel like the odds were if there was going to be a direction on the euro today, I thought the odds were in favor of dollar strength. I think I mentioned that before the news came out too. I saw higher odds of a dollar rally versus a weak dollar, and actually neither the bears nor the bulls can declare victory of these thus far in this post-news response. The reason why I expected a dollar rally was because I thought either the Fed would disappointment the market because the market's had plenty of time to price in some form of policy move. So if the Fed did deliver something, I thought we might see a post-news reaction, sort of like a buy the rumor, sell the news scenario. Or the market like it did, they did following the August 1st announcement, the market would buy the dollar on the back of essentially disappointment that the Fed didn't do anything or didn't do enough. Now, time will tell how this, of course, how the market behaves moving forward here. But if the market's grossly underwhelmed or disappointed with this Fed announcement, as Andrew implied earlier, you'd expect eventually the dollar to firm up. And maybe it will over time. Yeah, Andy, did you see you saw the announcement by the German Constitutional Court yesterday? I realized it's 1 p.m. New York time. That went fast. That went really fast, it seems. It's kind of a whirlwind. Started this session 45 minutes, or started this event 45 minutes ago. Set things up before. Admit, and this isn't a criticism of FX Street. Again, you guys did a fine job, and 15 minutes was the right amount of time. But for me and what I'd like to do and such, I really get into this stuff, and my explanations, some of my descriptions of things are longer than perhaps what they need to be or should be. I probably could talk a half hour, 45 minutes, setting this whole news event up, talking about different economic data, different scenarios, what could happen in different types of announcements. But again, I get into this more than others, and perhaps provide more information than what I should, especially could be confusing to newer traders. But anyway, 15 minutes we covered the few things, previous post news reactions. I referred to a couple of what I considered a couple of key statements from the latest FOMC meeting minutes, plus Bernanke's Jackson Hole speech. And then we got the news announcement and choppy reaction since. So, Andy, help me again. What were you hearing, and what's the source in terms of what the market was expecting? I mean, when it comes to stuff like this, it's to me, it's always can be a vague concept. What the market was expecting versus what the market got. It could be something that's very challenging to define. Now, what I found was an interesting source of that was the survey conducted by CNBC. There's something else I didn't refer to. A study done by, I can't remember the investment bank, but I saw some investment bank, maybe it was Capital Economics, some firm did a study on what the market are priced in, and I've seen the range from like 500 billion to 800 billion in QE3. But even that study didn't cite the makeup of the buys by the Fed. I'll be interested to see what the headlines show tomorrow. Again, do the math on this, guys. Do the math on this. $40 billion per month, as I still see it. Maybe I'm missing some headlines here. Maybe maybe someone else has broken this down for me. $40 billion per month in mortgage-backed securities. Kevin mentioned earlier some stabilization, but I haven't. I'd like to read more into that. I haven't seen that yet. I see a Bloomberg article here, which I'm going to scan through real quick, see if they make a mention of it. Well, for right or wrong, again, it'd be interesting to see how the media dubs this, but for what it's worth, Bloomberg has deemed it QE3, a third round of quantitative easing. They describe the open-ended, and that's the way I saw it too. Bloomberg describes it as open-ended purchases of $40 billion of mortgage debt per month. Skim through the rest of the piece. about it. No reference again from Bloomberg either about sterilized purchases. I'm just referring to Kevin's comment earlier about sterilized purchases. It may be somewhere. Maybe it's maybe the devil's in the details. Bernanke, again, due to deliver a press conference starting a little more than 1 hour from now. All right, Andy, I saw your comment. I saw your response to my question about your sources there. So, yeah, that's cool. But Harley mentions, not doing anything radical. Well, is this radical? Well, it's, to not do anything radical would have been, okay, Harley, in my opinion, to stand pat and wait till after elections meant no QE. I mean, no policy move. What would have been deemed, in my view, a modest move would have been only guidance. What if the Fed had only said, we commit to keeping the Fed funds rate low through the end of 2015? That would have been a baby step. Harley, I don't consider today's action a baby step. My personal opinion. I haven't read the details yet, but my take is this is not a baby step. Now, is it a hugely bold move? I don't see this as exactly playing it completely safe. Yeah, Money Magnet, that's a great question. Seriously is. I wish I had the answer there. I wish I had the answer. I mean, if you're at the question so many are asking, the question I'm still asking is, where's the benefits of the first 2 rounds of quantitative easing? Now Bernanke himself, I'll quote again what he mentioned at his Jackson Hole speech. Let me cite this. Look at that. The studies by the Fed, again, I'm not defending Bernanke. I'm not defending the Fed. I'm just citing what he's saying now. I don't know if there's ever going to be a reasonable, reliable way of defining or of confirming or validating what the Fed has done. I mean, there's one study I think it's by the Fed there, by the boards, the Fed board, saying that they found in their models that, or they believe that the prior QE1 and QE2 has helped increase, help create 2 million more jobs than what would otherwise, and by the way, the bold face is mine, relative to what otherwise would have occurred. So now, now the question is, will this actually boost the construction industry to a degree that would not have otherwise occurred had they not done it? Again, I don't know. Back to 29:30. I really probably need to wrap this up. My apologies for compromising anyone's time, especially those at Epic Street. If this room is still open, if this room if the next event isn't going to be for another hour, I will stick around and answer questions or address comments and be happy to chat with anyone about either the market's reaction or what was said or not said by the Fed. Again, but by the way, if I sound overly critical of anyone, it's not meant to. I would, if any boot campers here would know that any comments stated by another boot camper or by another currency coach at boot camp, and I'll pick it apart, and I expect anyone to pick apart my comments. It's all in the spirit of good debate, and I'll tell you, there's a lot of debates occurring in a lot of circles. You name it, coffee shops, U.S. Congress, so the Federal Reserve. There had to be a fairly heated debate at the FOMC during yesterday's and today's meeting before they made this announcement. I can imagine the likes of Richard Fisher from the Dallas Fed, Plotch from the Philadelphia Fed, probably standing up on a table, beating on a wall, saying, "Bernanke, don't do this, don't do this." I don't think Fisher or Plotcher wanted to do any more QE at all. And if I had my druthers, I would say this: if I were king of, if I were the top dog in the U.S., top policymaker, I would say, you know what? Let's take our pain for 1 year. So if you really want to know where I stand, that's it. I'd say take the pain for a year, whatever the pain needs to be, and then we'll go on with life. The policies, right or wrong, that are pursued by the likes of the Fed and even the U.S. government seem to be, rather than take all the pain at once, let's drag it out so that we're looking at kind of like stumbling, muddle through sort of economy for years. Yeah, gold's taking off there. Well, you know what? In fact, like gold tells you something, right or wrong. If you look at this move on gold, is the gold market disappointed with what was announced by the Fed? I don't think so. If the gold market had been disappointed about what the Fed announced, you'd see gold sell off, in my humble opinion. Gold's been a pretty decent gate. It's an interesting level they're coming up on gold, though, for sure. So yeah, so I'd rather tell you move on gold. Folks, have a great day. Again, I'll keep the charts up. FX Street, when it comes time for me to turn off charts, or you can kick me off, or or just send me a private message and I'll turn off the charts. I'll be around here. Got some other work I'm going to do here in the office. So I'm going to be here at the desk for a while. Folks, thank you very much for attending. I hope at the very least that no one got hurt with regards to any trades you took, or actually, if you're drawing about a trade miss, such as maybe a euro long, close to like 28.90, and there was some case for the trade, but believe me, folks, you're going to have probably much more reasonable, much more, you might say, trustworthy, much more comfortable trades to take, likely in the next three trading sessions, Asian session, particularly next tomorrow's London session. Remember, the European trader is largely out of the market right now, so you'll get a chance to see if you can make profit from Asia's reaction, especially the Europe's reaction to this Fed policy move. Folks, have a great day. Cheers.